Multiple analysts and major investment banks are now making the call that the euro is heading to parity versus the US dollar and potentially even lower. This is the latest piece of Forex and stock market news that I want to cover in today's video. And we're going to be looking at the top 5 currencies that are set to suffer from this unfolding US dollar rally. And we're also going to look at the quantitative targets for those currencies versus the US dollar for the remainder of the year. Kicking off with this headline out of Bloomberg, China seen countering Trump tariffs with stimulus, weaker Yuan. Most economists expect Beijing to raise broad budget deficit, China likely to target farm goods in response to Trump's levies. China may embrace greater stimulus, bolster manufacturing, and allow the yuan to weaken to offset the negative effects of a second Trump presidency on the Chinese economy. So what we're seeing here is as Trump starts to impose tariffs, and this hurts the Chinese economy, which has already been suffering recently, the Chinese authorities are going to have to stimulate to try and offset the negative impacts on their economy. And they're going to do that by devaluing the yuan, amongst other things. And if we have a look at the Chinese policy options to respond to the Trump tariffs, you can see that they can raise the budget deficit or they can loosen monetary policy as really the top 2 measures that they can take. And more than half of the respondents said Beijing may weaken the yuan, which would make Chinese exports more competitive and help offset some of the potential tariffs. Economists differed widely on the extent of any such currency depreciation, with estimates ranging from 7.3 to 8 per dollar for 2025. So one of the key takeaways I want you to pay attention to there is that China is going to have to offset the damage to their economy by taking stimulative measures. This is going to devalue the Chinese yuan, and some economists are looking at the Chinese yuan potentially going to 8 versus the dollar. Now, the Chinese yuan is a pegged currency, so we're not really looking to trade pegged currencies. But the key takeaway from that last point was the competitiveness of Chinese exports. Why is that important? It's important because if Chinese exports become more competitive, other countries who are trading with China are going to import more from China. And who are one of the largest importers from China? Well, if we look at the 2022 stats, you can see China exported $178 billion to Japan. So what we're looking at here is a significant knock-on impact to the Japanese economy with a yuan devaluation. Why? Because what we're going to see is Chinese exports becoming more attractive to the Japanese consumer. And as their propensity to import increases, they're going to go out and they're going to buy more Chinese exports or Chinese goods and services, and they're going to supply or sell Japanese yen in order to do that. And this is going to put downward pressure on the Japanese yen. And as you can see, this is going to be a problem because Japan already intervened twice last quarter to bring the yen below 160. Trump's election win has spurred a yen slide, prompting warnings. Japan said it stepped into the foreign exchange market twice last quarter as speculation grows that more moves may be brewing given the recent bout of renewed yen weakness. But following Donald Trump's victory in the US presidential election on Tuesday, the greenback has surged against a range of currencies around the world, and the yen is once again at risk of further softening. Wall Street is betting that Trump's presidency could result in policies that strengthen the dollar, as tariffs on US trade partners and tax cuts at home could drive inflation and higher interest rates. So again, these are the policies that we talked about in last Wednesday's video causing this dollar rally because of higher interest rates. And this is coming at a time when the yen is already weak. So the yen is really set to suffer from a rally in the dollar, because not only was it already weak and we're already seeing the BOJ intervening, but it's going to restart that yen carry trade where people are converting out of yen into dollars. And at the same time, we're going to see more downward pressure on the Japanese yen as Chinese exports become more attractive to Japanese consumers. Now, on top of that, the yen has another problem, which is that as the yuan devalues and the Chinese exports become more attractive, they're not just more attractive to Japan and Japanese consumers, they're more attractive to the rest of the world. And you can have non-Japanese consumers starting to import or buy from China instead of from Japan. And if that is the case, we're going to see another slowdown in the Japanese economy. And this is also going to mean that the Bank of Japan is going to be somewhat pressured to stimulate. And if we get a slowdown in China, Japan, in Asia, which economy is going to suffer the most? It's going to be our good friends over in Australia. If we look at Australian exports by country, you can see by far and away China and Japan are the top exporting destinations for Australian goods and services, primarily goods. So as Trump enacts those policies primarily to target China, this can have a knock-on effect on Japan, and the combined result will have a knock-on effect on the Australian economy. And the Australian dollar is going to suffer because not only will there be less revenue through the balance of payments, in other words, there's less people demanding Australian dollars, because when Australia exports a good or a service, they demand their own currency for that. And so demand, as exports go up in Australia, demand for the currency goes up, and vice versa. If exports fall, then the Australian dollar is going to suffer. And if the economy slows down, it's going to suffer even more, because Australians are going to have to stimulate their economy by devaluing the Australian dollar. So after the Japanese yen, the Australian dollar is the next currency that is really set to suffer from the new tariffs that are likely to be installed by the Trump administration. If we head back over to Bloomberg, you can see Australia faces economic pain from Trump when Treasurer warns Australia won't be immune from escalation in trade tensions. Chalmers says Australia is prepared for the Trump administration. Australia faces the threat of short-term economic pain in the form of reduced output and further inflation pressures as a result of incoming US President Donald Trump's policy agenda, and that's according to the Australian Treasurer. So if Australian exports are going to be hurt by this policy, which other countries' exports are going to be hurt, and by extension are going to see their currency suffering as the monetary authorities are set to stimulate to offset the damage and also devalue the nation's currency? Well, if we look at the Mexican exports by country, you can see the US is absolutely, by far and away, the #1 destination for exports. And as the US imposes tariffs, this is going to have a major negative effect on the Mexican economy. Back over to Bloomberg, where you can see the Mexican peso slumps on fears of US trade protectionist pivot. The currency hit a 2-year low during the election vote count. Mexico's peso weakened on concern President-elect Donald Trump will make good on his promise to implement a new order of trade protectionism in the US. So they're talking about tariffs. The article goes on to say now investors will be closely monitoring Trump's staff appointments to gauge to what extent he will follow through on campaign promises. Well, we only have to look at the 2016 administration to see that Trump did in fact follow through and impose tariffs, and it seems extremely likely that Trump is going to follow through on his campaign promises and implement tariffs once again. So as we wrap up the fundamentals and move over to the charts, the US dollar versus the Mexican peso is another market we're going to be looking at, with the Mexican peso the next currency set to suffer from this US dollar rally which is unfolding. So what's the final currency we're going to look at in today's video that is set to suffer from the incoming trade tariffs and a dollar rally? And it is, of course, the euro. Why? Simply because the euro makes up 57.6% of the dollar index. So if the dollar rallies, the euro, by definition, is going to suffer. And here is the headline we kicked off today's video with: euro parity with the dollar is the big new call by currency analysts. Analysts forecasting euro to fall to $1 next year. US tariffs combined with German chaos spell worst case for the euro. The article goes on to say currency strategists are ripping up forecasts for the euro in the wake of the US election and coming up with a new call: a slide toward parity with the dollar. At least 10 banks, including Barclays, ING, and Nomura, have slashed their calls in the past week, a turnaround from recent months when many were lifting the outlook for the common currency. Pictet Wealth Management is also calling for parity, whilst Deutsche Bank sees a risk the euro could fall even lower. Bets in options show traders wagering against it as a favorite way to play the outlook for Donald Trump's presidency. And you can see the options markets are reflecting this as traders position for a euro move below the 1.05 level. So let's now go and have a look in the Hedge quantitative analytics platform at these currencies versus the dollar to see where the high probability targets are for the rest of the year for these currencies versus the US dollar. Starting then with the Australian dollar versus the US dollar, because we've already looked at how exports out of Australia are likely to be impacted by a slowdown in China and Japan. This means less demand for the Australian dollar, and it means that if there's a slowdown in the Australian economy, the Australian monetary authorities are likely going to have to stimulate and weaken the Australian dollar. Now, if I turn on the annual levels in the Hedge quantitative analytics platform, you can see the projected level to the downside for the year, which we got in the Hedge platform at the beginning of the year, is the 0.62201. So we still have plenty of downside left for the year. This market essentially has fuel, it has runway to get down to the 0.6220 still this year. And that remains significant downside in the Australian dollar this year. Now, once we trade into the 0.6220, we run into the annual, for those of you who follow the weekly Forex forecast levels, we run into the annual lower bound. It means that the Australian dollar has roughly a 30% chance of continuing with any significant downside, and it will probably, breach it and it might push through a little bit, but any significant downside below the 0.62201 only has a 30% chance this year. So if we hit that target, that would be a great profit taking target to the downside in Aussie US dollar for the year. We could very easily bounce before we continue lower perhaps next year. If I zoom out on the Australian dollar as well, you can see the yearly lower bound actually sits right at the low of this major down move here. So I would not be surprised to see a breach of the 0.62201, especially if we breach it and take out this low. That's going to be a great target to assess for downside in Aussie US dollar over the remainder of this year. The next market we're looking at here is US dollar Japanese yen, and you can see already this year we have traded above the 153.27. That is the annual upper bound. It means that if you push above this, you're likely to snap back inside this range with roughly a 70% expectancy. So in terms of US dollar yen, it does look like there is somewhat of a ceiling placed on this now, and any upside may actually be a little bit difficult for the remainder of this quarter. So if you are looking to benefit from any US dollar rally, you may find the best opportunity out of Australian dollar and the Japanese yen for the rest of this year. We're not talking about next year, but the rest of this year would be Aussie US dollar to the downside instead of US dollar yen to the upside. If I turn on the monthly levels here, you can see we do have a price target to the upside of the 159.26. So if we are going to get more upside, the 159.26 is where you should be looking this month for potential profit taking in the US dollar Japanese yen to the upside. However, as I've just said, because we're already above the annual upper bound, this market is beginning to run out of runway, and I would prefer Aussie US dollar shorts into the back end of the year because of that. And the final market we're going to look at here, of course, is euro dollar. This is the market which the big call was all about, with the euro heading to parity against the dollar. And I personally agree with Deutsche Bank. I think the euro is going lower than parity, and I'm going to show you why and also when I think that's going to happen. And that starts with turning on the yearly levels in the Hedge Dash quantitative analytics platform, which, by the way, all GMT members get access to as part of their GMT membership. There's no extra charge for that for them. But to the downside here, you can see the 1.0390 is the annual lower bound. So we still have room left to go to the downside. So what I like here is primarily Aussie dollar and euro dollar to the downside in the back end of the year. But then all four of these currency pairs, certainly next year, I think we can look at for outperformance of the dollar versus those currencies, not just technically speaking, but because of those fundamental reasons we've already discussed in the video today. So we still have runway to the downside. I mean, any kind of pullback into its moving average roughly, on a daily time horizon should set up most likely one final move down into the 1.0390 by the end of the year. And the other thing I want to do is I want to zoom out here because I want to show you something. Even though we may only get to the 1.0390 this year, you can see we're setting up here a major breakout to the downside. We've got this correction and we came into this to the downside. And very often when you get that, even though it takes a long time, you get a retest and usually another low. So what we're looking at here is most likely a head and shoulders. Now, it's not a textbook one you'd be used to, but the psychology is there where we have a higher high, then we have a failure to make a high. And that gives us this kind of right shoulder. I know that you might say, well, it's not a right shoulder, but overall, this is a right shoulder because it's a failure to make a new high. And as this sells off and we break here, this is where you get a potential third wave kicking in. Now, again, we may break here with momentum, trade below the 1.0390, and that might be pretty much it for the year. We might only get that over the next, say, 6 weeks or so. However, coming into next year, I would be looking for a pullback, maybe sort of January, February, and then the back end of that year, or maybe Q2, Q3, Q4, I would be looking at the next leg down in the euro versus the dollar. And not only to take out parity, which sits around here, but as I've already said, I agree with Deutsche Bank. I think it's going much lower, and I think we should be looking at the major low at around 0.9596 in euro dollar next year. That is where I think euro dollar is going to go, and it's a big fundamental move to the downside that I'm going to be focused on, not just for the rest of this year, but also next year. So that is it from me for today, guys. As always, I hope you enjoyed today's video, and if you did, why not consider joining us in the GMT training room each day, where I look at the best markets as well as sharing real-time setups that I'm personally looking at trading with members as part of our GMT training program. Don't forget, you can also get a 2-week free trial to the cutting-edge hedge-trading app used in today's video by heading over to www.hedge-.com. Access to the cutting-edge hedge-platform is included with every GMT membership.